If you don't know who Michael Burry is, you need to. He is a big name in the financial world and is known for famously shorting the housing market before the 2008 crash. There was even a movie about him called The Big Short. Ever since his foresight of the 2008 crash, investors have paid attention to what he is doing, what he is saying, and most importantly, what he is investing in. And his hedge fund's last filing showed something that is sounding a red alert for investors all over the world. But before we get into his 13F filing, we need to know what he's thinking. Recently, Burry has made it known that he foresees a household debt crisis that will put the economy in serious danger. Michael tweeted, "Net consumer credit balances are rising at record rates as consumers choose violence rather than cut back on spending in the face of inflation," along with a graph from Bloomberg showing U.S. consumer borrowing increased by $40.2 billion in June, and according to the Federal Reserve, this was the second largest increase ever. These stats aren't just concerning to Michael Burry. Any rational investor could see the problem with debt rising at a record pace. The problem is not only debt rising, but it is also the fact that it is rising with inflation hitting over 9%, and interest rates are rising. Imagine this. One consumer takes on $100,000 in debt that must be paid off over 10 years with a 3% interest rate in 2021, and another consumer takes on the same amount of debt, with the same terms, except this consumer has a 5% interest rate in 2022. Consumer 1 will have a monthly payment of $966. Over the course of 10 years, she will pay a total of $115,873, or $15,783 in interest alone. Consumer number 2, with just an extra 2% increase in interest, will spend $1,060 a month, coming out to a total of $127,279, or $27,279 in interest. This means that he will end up spending an additional $11,496 over the course of his loan. That comes out to an extra 11.5% of his principal compared to consumer 1. Interest is only the first part of the issue though. Along with an additional $100 a month that consumer 2 has to pay on his loan, he also has to pay an average of 9% on everything he buys. This means groceries, gas, baby products, etc. If consumer 1 spent $5,000 a month on living expenses, and consumer 2 had the exact same living expenses, because consumer 2 is living in a time with much higher inflation, he will pay an extra $450 every month. With all of these extra costs, it only makes sense that Michael Burry is concerned about the status of our economy. Remember that red alert we said Michael Burry set off? Well, it's more like 10 red alert going off at the same time because Michael Burry's latest hedge fund 13F filings showed that the infamous investor sold every single company in his portfolio except one. The companies that Burry offloaded include Warner Brothers, Sportsman's Warehouse Holding, Stellantis, Nexstar Media Group, Ovintiv, Cigna, Global Payments, Bristol Myers Squibb Company, Booking Holdings, Alphabet, and Meta. The only stock he held onto was Geo Group. Geo Group is a company that mainly develops prisons, but also provide in-custody rehabilitation, and post-release support, secure transportation, and correctional health and mental health care. Geo Group is the second largest private prison company, owning 103 facilities with approximately 83,000 beds. If you enjoy our content, don't forget to like this video and subscribe to our channel to stay up to date with market news. Thanks for watching and stay informed.